Hi, Carl. Happy Friday, everybody. New highs, but more importantly, we are halfway through the third quarter. That's right, believe it or not, halfway through. And the important thing, the two main narratives remain in place. That is, the Delta variant is slowing but not derailing the recovery. And interest rates have bottomed, or at least the market believes that. Take a look at sectors right now here. Kind of a flattish open, about even on the advanced decline line. Communication services strong. That's because Disney had that great report. They're up nicely of almost 4%. Tech's holding in there despite slightly higher interest rates. That's the big story. I'll show you that in a moment. Banks have been doing great as interest rates have moved up. Flattish today, as you can see. Energy's the big disappointment this quarter, down about 8%. So we are anti-lockdown and we are anti-low rates at this point. You can see the market. I want to show you the industrials and big material names because for the quarter, halfway through the quarter, 6 weeks in, they're holding up really well. So Nucor, Dover, Martin Marietta. So some of the crushed stone companies doing really well. Deere doing really well. This is, again, the last 6 weeks. Also, rates have been rising. So you see, ever since the jobs report, the banks have been doing much better. We've been talking about Morgan Stanley, Goldman Sachs. It's hitting 52-week highs. NASDAQ's been doing really well. T. Rowe Price also been doing well. Consumer stocks are split. We've got that small group of super sellers. That's what I call them, Target, Costco, and Walmart. They've been fantastic in the last few weeks. No decline there. And we've also seen consumer discretionary stocks doing really well. Why? Because the consumer is flush with cash from savings and from stimulus. So that remains strong. They're fixing up their homes, as you can see here. They're going out to restaurants. They're buying cosmetics. Ulta has been a really good performer as well. So broad consumer spending is still pretty strong. Food, though, and other staple names are down. Consumers are spending less on food at home. So this is not surprising at all. This sort of makes a lot of sense. These stocks had big run-ups last year, and in the last several weeks, they have been underperforming. The big wild card is tech everybody's trying to figure out. And remember, tech is very sensitive to higher rates. This happened in February when tech got clobbered as interest rates moved up. So the good thing here is techs are sort of performing in line with the market. Mega cap FANG names are generally outperforming the market. Semiconductors are underperforming slightly in the last few weeks. It's not causing a lot of concern. I think the important thing is what would happen if we go do 1.6, 1.7 on the 10-year. That may be a little bit of a bigger problem. But right now, tech's handling the slightly higher rates very well. The bottom line is the higher rates are helping the markets look through the Delta worries. Modestly higher rates are not hurting technology right now. That's the key. Finally, I just want to note what's going on in Europe. Very unusual situation. Europe is up 10 days in a row. And I watched the Stoxx 600. This is the S&P 500 of Europe. It's the broadest index. 10 days? That just doesn't happen, folks. That's an historic high. Germany's at a new high. France is at a new high. And right now, the Stoxx 600 is outperforming the S&P 500 this year, up 19%. This just does not happen very often, folks. It's been a long, dry spell for Europe. Let me just show you the Stoxx 600 against the S&P 500. It's essentially, Europe has underperformed the United States really since the financial crisis ended in 2009. There you can see the S&P 500. That's the orange line, the big outperformance. And I'm going to go back even further. You know, look back 15 years, even you can see that. So the important thing is Europe's up 100%. The S&P 500 in the last 10 years is up 270%. And guys, the important thing, Carl, is Europe's cheap. It's about 15 times forward earnings. The S&P is 20 times forward earnings. So on a relative valuation basis, it's a great call. Whether or not Europe is going to emerge quicker from this pandemic is not clear. But obviously, Carl, some people are betting that they will right now.
Shepard Smith here. Thanks for watching CNBC on YouTube.